Hello and welcome to this comprehensive analysis of the iShares China Large-Cap ETF, or FXI for short. First, let's start with a brief overview of what exactly this ETF is. The FXI tracks the performance of the FTSE China 50 index, which consists of the 50 largest and most liquid Chinese companies listed on the Hong Kong Stock Exchange. These companies are typically leaders in their respective industries and are well-established, blue-chip companies. The ETF is managed by BlackRock and has a total asset size of over $8 billion. Now, let's dive into the performance of the FXI. Over the past year, the ETF has returned a modest 3.84%, which is lower than the overall performance of the S&P 500 index. However, it's important to note that this return is in the midst of an ongoing trade war between the United States and China, which has caused significant market uncertainty and volatility. Despite this, the FXI has still managed to outperform some of its China-focused peers, such as the iShares MSCI China ETF, which returned just 0.76% over the same period. This is likely due to the large-cap focus of the FXI, as these companies tend to be more stable and resilient in times of economic uncertainty. Now, let's take a closer look at the top holdings of the FXI. The top three holdings make up over 25% of the ETF's portfolio and include China Mobile, Industrial and Commercial Bank of China, and China Construction Bank. These three companies are all leaders in their respective industries and are well-known and respected globally. It's also worth noting that the FXI has a relatively low expense ratio of just 0.74%, which is lower than the average expense ratio of comparable China-focused ETFs. This means that investors can expect to pay less in fees, which can ultimately lead to higher returns on their investment. So, what are the potential risks and considerations for investors considering the FXI? As with any investment, there are always risks to consider. One potential risk for the FXI is the potential for economic slowdown in China. As China is the world's second largest economy, any slowdown could have significant implications for the global economy and could negatively impact the performance of the ETF. In addition, there is also the potential for geopolitical risks, such as the ongoing trade war with the United States. This has caused significant market uncertainty and could potentially impact the performance of the ETF. Finally, it's important for investors to remember that the FXI is focused on large-cap Chinese companies and may not provide as much exposure to the smaller, more growth-oriented companies that are often found in the Chinese market. Overall, the iShares China Large-Cap ETF is a solid choice for investors looking for exposure to the Chinese market. It offers a diverse portfolio of well-established, blue-chip companies and has a relatively low expense ratio. While there are always risks to consider, the FXI has managed to deliver solid returns despite the ongoing trade tensions and economic uncertainty. As always, it's important for investors to do their own due diligence and consider their own investment goals and risk tolerance before making any investment decisions. Thank you for watching, and we hope this analysis has been helpful.